Hello and welcome to this special conversation on CNBC-TV18's IPO KYC show. I'm Ritu Singh. Now this is a special listing. It's one of the largest IPOs by an NBFC in recent times and the first one from the HDFC group in nearly 7 years. HDFC Bank subsidiary HDB Financial is set to go public with its 12,500 crore rupee IPO, which comprises of 2,500 crores of a fresh issue and 10,000 crores of offer for sale by the parent HDFC Bank that owns more than 94% stake in the company. The issue will open for subscription on the 25th of June, close on the 27th of June, and the price band has been set at 700 to 740 apiece. Now, the listing is not just strategic, it is also regulatory because as an upper layer NBFC, HDB Financial must get listed by September to comply with RBI regulations. On that note, let me welcome the man of the moment, Mr. G. Ramesh, the MD and CEO of HDB Financial. Sir, thank you very much for your time here on CNBC TV18 and congratulations on finally, start the process of going public. Let's start with the price band itself. It's 700 to 740 apiece. It's kind of quite a surprise to the markets, if I would put it like that, because, compared to the unlisted price of 1,200, 1,240 apiece, why the deep discounting?
So thank you for inviting me here today. The company is about 17 years old. We've had a profitable track record for most of our journey. The first year that we were in business, which is the financial year 2008-9, we made a marginal loss, but we've been a profitable company ever since. We have a large franchise. We have presence in over 1,170 cities. We are a well-scaled company. For us, the IPO is really a milestone in our journey. Our whole focus as an organization has been on building value, right, both for our customers and for our stakeholders. The price is really a reflection of what our investors that we've been engaged with for the last few months and what our BRLMs have advised us.
Okay, but it would be fair to assume, given the regulatory uncertainty surrounding, what RBI's draft rules say about overlapping businesses between banks and their subsidiaries, is that the reason you had to take a bit of a cut over what you were expecting?
So look, the draft form of business circular, the draft came out in October, sometime in early October 2024. It's about 8 months now. I can't really speculate on what the final circular will say, so can't really address that question.
But that is the biggest question in the investor's mind. I mean, how are you going forward with this IPO with that big uncertainty still looming large? What is your understanding as far as how this could proceed if the draft were to be implemented in its current form?
So we started off as a subsidiary of HDFC Bank. We have built over the years, and one of the interesting things is that though we have 19 million customers today, they've been originated by the company. We don't get any leads from anywhere. We don't get leads from our parent or any other companies. These are customers originated by the company itself. So we have an independent origination engine, an independent risk management engine. Our technology platform is independent. We have more than 1,700 branches across the country. These are independent branches, they're not part of a HDFC Bank branch. These are independent branches. And so we have an engine that's independent of our promoter. We have a lot of guidance from them, in terms of corporate governance, or whether it's risk management, or whether it is, how do we manage a business through cycles. But at operating level, we are independent business, no deputation of staff from the bank to our company. So it's built and run as an independent company. So the company's characteristic is not going to change in any manner in the years to come.
Well, it is an independent company, and now that you're going to be public, you're going to be responsible to the shareholders. But the fact of the matter is, the HDFC Bank, if it has to bring down its shareholding, last year the bank was in talks with strategic investors. We do not know if those will fructify, if you're still in talks with them. But, what is the various sort of outcomes that you've planned for, the kind of surety that you can give to investors at this point in time?
So we are an independent business, set up and run independently. We have a board that is competent and a management that's competent. So we've run that business. What the promoter will do in case a circular comes about is at this point of time speculative.
But the fact of the matter is your rating is very much linked to your parent. That impacts your cost of funds directly. If that were to change, how would life change for HDB?
So we have a portfolio of businesses, and for us, our philosophy has been how do we deliver value to the customers through their life cycle. We have a bunch of products that are built around aspirational India. So when we think of our customer, which is aspirational India, we're saying what is it that this customer needs through their life cycle, and how do we fulfill that requirement? So customers have requirements around their business, and customers have requirements on their personal requirements, consumption, or buying products for the home. So irrespective of what the customer needs, our philosophy is how do we build a suitable product or service that fulfills that requirement. And we'll continue doing that in the years to come.
Just a final question before we move on from this issue. Have you engaged in discussions with the regulator? Are you able to convince them that the businesses are separate? Because when you look at LAP, consumer finance, vehicle finances, these are overlapping businesses between the parent and you. How is the customer segment different? What sort of dialogue have you had with RBI about this?
So we work with Aspirational India. This is a customer segment that's fairly heterogeneous in the way they speak languages, the businesses they run, or what their aspirations in their life are. We have presence in over 1,100 cities. We have built the capability to deliver credit at scale to a very heterogeneous market. Right? Finally, there are finite ways of delivering credit, and that's what we are focusing on. What is it that our customers need, and how can we deliver that requirement effectively? We don't do any arbitrage. We don't do any businesses that banks are prohibited from doing. I think we are quite comfortable with the fact that we are doing a business to a customer segment and delivering a product and service effectively in a very responsible and competent manner.
So that's the case you've made to RBI?
I can't tell you about it's confidential conversation that we have.
All right, fair enough. You're also raising about 2,500 crores through the fresh issue apart from the OFS component. You're very well capitalized at this point of time. Your total capital adequacy at 19.2%, Tier 1 capital at about 14.7 almost. What sort of boost will this give to business with the additional capital that you get, and how long do you think this will suffice for the NBFC?
So, since we are doing an IPO, we felt that it's also important to look at the next few years and make sure that we don't come into the capital markets a few months or years after doing an IPO. So we felt that this is the right time to raise capital. We expect it to last to about 3-4 years. Having said that, if the Indian economy has a huge flip up, I'm sure the investors will be kind to give us more money.
All right. Let's get into the financials then. We understand, of course, you can't make any forward-looking statements here, but FY25, your last reported numbers, it's not really been a very good year. Profits have come down. Credit cost has shot up sharply for the bank. ROA has fallen. Growth has been uneven. Would you be able to at least give investors the confidence that things will start to turn around from here on?
So, again, had a huge track record as a company of being a profitable growth company, right? So we will have events, macroeconomic events or microeconomic events that require us to adjust our portfolio and adjust our growth rates. That's something we are comfortable with as a company. We believe that we have to manage growth with profitability, right? We can't forsake one for the other, and that's what we've been doing. So some of these numbers will go up and down a little bit, but in terms of a growth path, we see a very clear opportunity ahead in terms of both the markets and our ability to service those markets.
But the large pain point has been stress, especially in the unsecured book. We've heard commentary from the Reserve Bank of India governor saying stress is starting to abate. Is that something you're seeing in your portfolio as well?
So the unsecured business is something we've been doing since about 15-16 years. It's a business we understand well. Again, our business is not about creating a program and then spreading it across the country. Whenever we open a branch, we try and understand what is it that drives the local market in terms of the opportunity. How do we adjust our credit policy and our product delivery to the local requirement? So we are, so what we have the ability is to understand depth at scale. So there's a layer of technology on top which analyzes what's happening in the micro market. So not only are we getting signals from our own field in terms of our own origination and our own collections teams, but also what our analytics is telling us about each market. Okay. So we fine-tune our portfolio, fine-tune our credit processes to make sure that we are covering our risks well, leading into opportunities, and that's how we refine our business all the time.
So would credit costs come down from the current levels?
So again, I can't give you a forecast, but our credit cost is finally a function of the product portfolio that we generate, right? And one of the ideas of having a large product portfolio of the kind that we have is the ability to allocate capital to businesses that we think have a good growth potential in the immediate next 12 months, and sort of slow down the allocation of capital to business that we think we should slow down for macroeconomic reasons. And that's how we arrive at a return on capital that we expect to give our shareholders.
So if you're looking to slow down because of macroeconomic reasons, as you say, currently unsecured is almost 27-29% of your overall book. Should we expect this mix to continue? Are you going to be more aggressive or less aggressive on this front to chase higher yields?
So as of March 31st, 2025, we had about a 73% secured book and 27% unsecured book. We're broadly comfortable with with that range at 25-75 to a 70-30.
Okay, so no broader change in the mix. But the dependence on the vehicle finance segment, I mean, across your enterprise and consumer loans, almost 47% of the book is to vehicle loans alone. And at least from the numbers that have been reported by the industry so far, that is a segment that has not been doing too well. We've seen single-digit growths. Even for you, there was a huge spike in NPAs last year in this particular segment. Going ahead, are you seeing any improvement both on the demand front and the asset quality there?
So we have a large presence. We are a large player in the vehicle finance space. India, again, because it's a heterogeneous market, vehicle sales depend on the local factors. So there'll be different types of vehicles that get sold in different markets. For us, the whole opportunity is to align our business to the local opportunities, right? There are markets which are LCV markets, there are vehicles which are trailer markets. So we choose which markets and which segments to focus on so that we can maximize our returns.
All right. So, again, 70% of your book between vehicle finance and loans against property. Will that mix continue, or what are the areas of opportunity you see from here?
So I said, from a secured, unsecured, we think a 75-25 to a 70-30 is something that we are comfortable with. It's, something that we'll continue to focus on.
But in terms of white spaces or areas of opportunity for you, are there newer segments you're looking at? Will you continue to focus on these?
All the time. We're looking for newer spaces all the time.
What would those be?
I can't tell you that. That I can't tell you. My lawyers will kill me. We have deep presence in all the geographies that we work in, right? I mean, we have physical presence, we have digital presence. So we're talking to customers all the time, right? On a daily basis, we're talking to hundreds of thousands of customers. So we are, those conversations lead us into what is it that the customers need, how can we fulfill that requirement. We don't think we have a full product portfolio yet.
Okay.
Also, as the economy evolves, the aspirations evolve, so there are new use cases that come up all the time.
All right, so we'll wait to hear more on that. But a quick word on your BPO line of the business as well. It was in 20-odd% growth, part of your revenue overall a few years back. Now it's come down to single digits. Is that the trajectory we'll continue to see? Will it continue to shrink as a part of your overall book? And does it still make sense to continue having this line of business to cater to, of course, the parent HDFC Bank?
Right. So our loans business has grown substantially. Right? We have a balance sheet size of 1,07,000 crores. Yeah. So as the loans business has grown, the BPO business as a percentage, has gone down from the teens to the single-digit numbers. It's a business that we do for our parent. We've been doing it since 2008.
And you'll continue to?
We'll continue to as long as our parent wants it.
All right. Another area of concern highlighted by investors when they look at your book has been the high cost-to-income ratio compared to all of your peers in and around the areas that you operate in. Is there a sort of roadmap you'd be able to give to investors as to how that could come down from the levels that it's at 49% or so?
So the 49% includes our BPO business, which operates at a much higher cost-to-income ratio. Our lending business is at about 43.5%. Right? I said our business is about engaging with our customers anywhere in India. It's a heterogeneous market, which requires us to put physical presence. Right. So today our customer can come to us in about 5 different ways, starting from a purely digital journey to a purely physical journey. There are about 5 ways that he can or she can come to us. What we have been able to do is to build the processes to make sure that irrespective of how the customer starts the journey, we are able to complete the journey in the same amount of time, irrespective of how the customer starts the journey. Right. Secondly, as I said, our business is about engaging the customer through their life cycle, right? And a lot of that requires a certain amount of touch right, light touch with the customers through the engagement, so that it's not a transaction where you engage with the customer on the loan, forget,
So
customer
you're
close the
indicating
loan.
the costs may remain high.
So, our business model, we are comfortable with that cost to income. We'll obviously have some efficiencies over the years, but our business is about the technology platform that we have and the distribution that we have, so that we can engage with the customer and build a profitable franchise.
Even on your margins front, for the last 2 to 3 years, we've seen some contraction there, and now in the current regime, interest rates are falling. Of course, the cost of borrowing for you will also fall. Do you have enough leverage to be able to expand your margins from the current levels?
So we have, a AAA rating on our long-term paper, right? That enables us to borrow money at the finest rates that are available. We are one of the largest issuers of NCDs in the Indian market. It's something that gets published all the time, raising money all the time. That's our raw material. So that we continue to do. There will be a certain margin contraction or expansion as interest rate cycles turn, right? I mean, in the last few years, there's been a fairly steep increase in interest rates, at the system level. But as again I said, our business is a fairly diversified business. Interest rates vary all the way from, single-digit numbers to larger values for a smaller value unsecured loan. And so we look at, again, returns and yields at a portfolio level. So we will do that fine-tuning from time to time, depending on which way interest rates are moving, so that we can generate a certain return or a NIM for our business.
What is the aspirational NIM?
We don't have an aspirational NIM. We have an aspiration that we should create value for our
Well, speaking
customers.
of creating value, what about the return ratios? Your ROA has fallen down to almost 2.16%.
Right.
The return on equity had touched 20%, is now back to 14% levels.
Right.
When do you get back to, sort of...
So our weighted average ROE for the last 3 years is 17%, which we believe is quite healthy. So there'll be a little bit of ups and downs, right? That's something that we'll have to work through as we, build the business.
Okay, but no target levels that you could, give some comfort to investors with?
So it'll be adequate that our investors continue to stay.
What is an adequate number?
So, look at our track record. You'll know what an adequate number is, in terms of what it is.
All right. Finally, in terms of AUM growth as well, you're now a 1 lakh plus crore business at the moment. You've grown by about 3 times in the last 7 years or so. Will we see a similar growth rate trajectory, say, in the next 5 years or so? Could you become like a 5 lakh crore business? What is the aspiration there?
So the opportunity exists. As a company, we had the mindset to diversify, right? As I said, we launched a new business almost every other year. We added about 200 plus branches in the last 3 years. So it's a mindset that we have in terms of, we believe that the opportunity exists.
Okay, but over the medium term, what sort of balance sheet size should we expect from HDB Financial?
So again, I can't give you any forecasts or forward-looking statements.
All right, we're going to have to leave it at that, but we wish you the best with this public offering. Thank you very much for your time.
Thank you very much,
Mr. Ramesh. Thank you.
Thank you.
On that note, it's a goodbye, and thank you all for watching.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube.
Hey, thank you for watching this on CNBC TV18. Hope you liked it. For more such interesting news and updates, follow CNBC TV18 on all the social media platforms.